A dividend is a payment shareholders receive from a company's earnings. When a company is profitable, management can choose to reinvest profits to help grow the business or distribute those profits to shareholders in the form of dividends. Dividends come in several forms, but the most common is cash, which is deposited into shareholders' investment accounts. For example, if a company declares a 30-cent dividend and you own 100 shares, you'll receive $30. Typically, mature companies with strong cash flows are more likely to pay dividends. Many investors seek the income associated with dividends and often view them as a sign of strength and positive expectations for future earnings. Companies often pay dividends quarterly. However, some pay semi-annually or annually. Keep in mind, companies aren't obligated to pay a dividend and can reduce or stop paying it at any time. Some investors specifically seek out and invest in dividend-paying stocks. Dividend stocks can provide income and potentially enhance a portfolio's overall returns. Since 1926, the U.S. economy has undergone many bull and bear market cycles. However, the income return received from dividends has been relatively consistent during this time period. In addition to potentially higher yield, many investors look for consistent and growing dividends over time as an indication of company health and likelihood of paying future dividends. It's also important to remember that dividends aren't guaranteed. Companies that pay unusually high dividends may not be able to sustain them, and if dividends are cut, it might send the stock price tumbling. Despite these risks, dividend-paying stocks tend to provide income while still allowing for the potential of stock price appreciation.